Assalamu alaikum. This is Kanis Fatumarani. Today I am going to discuss about the impact of COVID-19 on the trade balance of Bangladesh. Bangladesh, like many other across the globe, struggle with the number of infection and the new normal of COVID-19 social distancing, virtual meeting, online classes, etc. Since reporting their first case on March 8, 2020, as a result, people across all social economic background had been adversely affected. A 10-day lockdown was initially imposed by the Bangladeshi government with no further movement restriction post May 30, 2020. This, along with worldwide travel restriction, had major repercussion on the Bangladesh economy. However, their balance of payment through the pandemic may indicate otherwise. Bangladesh reported a staggering balance of payment bob surplus of 3.098 billion US dollar in the third quarter of 2020 compared to a deficit of 204 million US dollar during the same period in 2019. Again, during the first 9th month of the 2021 fiscal year, overall balance of payment recorded a big surplus, 6,990 million against a teeny surplus of 713 million in the same period of fiscal year 2020. According to Bangladesh Bank statistics, one of the biggest contributor to this surplus was the current account surplus, which account for the net exports, net income transfer, and net current transfer. All through Bangladesh reported trade and current transfer decide. Thus, we are heavily outweighed by the net factor income surplus, largely as a result of major remittance influx during this period. Despite higher unemployment worldwide, remittance inflows increased, flowing a small initial decline between January 2020 to April 2020 and hit a peak in July 2020. While an increase in remittance is a positive outcome as it provides government with more foreign currency reserve to manage the exchange rate by imports and attract investor. It was happening due to reason migrant worker losing their jobs and bringing back all their savings and 2% cash incentive on the remittance both back to the country. Furthermore, export and import both declined during the lockdown period as product halted. Export volume declined by 51.3% from quarter 1 of 2020 to quarter 2 of 2020 and reached all-time low of 510 million US dollar during April 2020, causing whisper unemployment in the short term. Import volume declined during quarter 1 of 2020 and recorded a low of 2.6 billion in April 2020. While a fall in imports may lessen the burden of import payment, it may also signal a decline in investment and the economy benefit from technology spillovers from imports, which the country badly needs. Another contributor to the Bob surplus in their capital account surplus, which account for capital outflows and inflows potential to foreign assets and liability in the country, most notably foreign direct investment (FDI). However, Bangladesh is also facing decline in FDI during the pandemic, some 6.68% from 804 million US dollar in quarter 2 of 2020 to 750 million US dollar in quarter 3, especially in developing countries like Bangladesh when it could be invested in infrastructure and or technology boosting productively. Additionally, a decline in FDI lead the capital account to worsen, leading exchange rate depreciation, making imports more expensive and failing further. However, after the successful vaccination vaccination program conducted by the government, Bangladesh is trying to get to its normal economic situation as well. The business activities have started is full swing. Thanks for watching my video. Allah Hafiz.